So the Reserve Bank is about to hand down its decision on interest rates, the last of the year. Market analysts expect interest rates to stay on hold at 3.6% today, and we'll look for clues on what may happen next year. We have our business team on hand for the decision. David Taylor is down at the Reserve Bank in Sydney, and Alicia Barry is with me in the studio. Hello to you both. Alicia, can I start with you? So is anyone expecting a move today?
Not that I've seen, Rose. So I just had a look at the market expectations just a second ago while you were talking, and there is a 1% chance of a rate cut today, but that is it. It's 99% chance that we will see interest rates on hold. The bulk of economists are also thinking the same thing. The attention around today's meeting is not going to be the decision itself, but it's going to be clues as to what the Reserve Bank is going to do next. It has been very determined to make the point that it is data dependent. It wants to keep inflation under control and employment stable, and it's going to do whatever is necessary to achieve both of those things. But inflation itself has reared its head recently, and that has changed the view by many market participants and those economists, with the direction of rates now being talked about as up rather than down, and that is a stark change from where we were just a couple of months ago when there was potential celebrations being planned for rate cuts ahead of Christmas. The market itself is pricing in an interest rate increase by August next year.
Let's go to our business reporter, David Taylor, now, who's at the Reserve Bank. Hi there, David. So most economists are forecasting no change to interest rates today, as we've been hearing from Alicia. But not that long ago, the opposite was true. There were expectations of a rate cut. So what's changed?
Good afternoon, Ros. Well, simply the RBA is focused almost exclusively by the employment picture on inflation. And when we got that new monthly October inflation number, it showed that inflation was actually moving in the wrong direction. So we're hoping inflation moves down to sort of 2.5%, right smack bang in the middle of the Reserve Bank's target band of between 2 and 3%. And actually, the headline figure moved up to 3.8%. And what's troubling is that, especially when you remove the energy rebates from both state and federal governments, electricity and gas prices continue to be sticky. But, Ros, also out-of-pocket healthcare costs, insurance, cost of building a new home and rental prices. All of these items that are sort of fall under the services sector aspect of the basket remain sticky and are causing millions of households around the country real problems in terms of sorting their balance sheets out. So it's difficult, but I'll just add this as well. If you're looking at the wages picture, we've got a relatively tight labour market and there is upwards pressure on wages. Now, combine that with low levels of productivity. Productivity is coming up a little bit, but not fast enough. And so that low level of productivity means that that per unit cost of labour for bosses is a little bit too high, and they're forced to pass on those higher wages to customers a lot of the time. So we're seeing inflation not only sort of settle around that 3% level, but move up a little bit. So this afternoon, it'll be fascinating to hear from Reserve Bank Governor Michelle Bullock to work out whether she's actually worried about that, or whether she thinks that as we move into 2026, that there'll be easing in price pressures. Maybe that comes from an increase in housing supply. Maybe that comes from increase in vacancy rates. Maybe that comes from insurance premiums coming down. Whatever it is, we need price pressures in the economy.
David, I'm going to interrupt you just for a moment because we have a decision.
In breaking news, no rate relief before Christmas. The Reserve Bank has kept interest rates on hold at 3.6%. No economists nor the markets were expecting a move today. It's the RBA's last meeting for the year. It next meets in February. The cash rate has been at this level since August this year, after the RBA cut the cash rate 3 times from the high of 4.35%.
So, Alicia, David there was talking about the change of mind that the Reserve Bank has had since the last meeting, since the inflation figures latterly came out. Inflation is getting hot again, as he was saying, but it's really the statement that will be coming out, or has come out, with this decision that'll be poured over, especially at this meeting, won't it?
That's right. The September quarter inflation figures were hot, and then the monthly October figures for inflation were even hotter, and that had the change of tone, I suppose, or change of expectation being priced into the markets by the economists and financial markets. However, the RBA has hinted at the idea that there could be rate rises. It hasn't ruled out rate cuts. It has been walking the line, talking about its dependence on the data, and we do have this new monthly series of inflation, so economists will probably want to see a couple of more hot prints before they really confirm the idea that that is the measure to go with. But in any case, it will be the language from the RBA's statement that is going to really give us an indication as to what it's thinking and whether or not it's going to really put a rate hike back on the table as the next move, or it's going to keep the door open for a cut as well. It is certainly something that is probably a disappointment to those who might have just hoped that we would get a little bit of rate relief heading into Christmas. But there's a lot of discussion now about whether or not this is the end of rate cuts, and this is sort of the neutral rate that will be where the board leaves the cash rate. But we do have an economist who might have had just a bit of a chance to read through the statement standing by, and that is senior economist Pat Bustamante from Westpac, and he joins me now. So Pat, no change was expected. It's a bit of much ado about nothing really today, but it is quite big when we look at the statement from the RBA. Have you had a chance to deduct the tone?
I've had a quick look over the last few minutes, and it's basically where we thought that the Reserve Bank Board would land. So one of the, I guess, key passages there towards the end of the statement is that the board needs a bit more time to work out whether this, higher than expected inflation will persist going forward. There is a view there that in the September quarter in particular, there were a lot of one-offs that led to the higher underlying inflation rate that we saw. And those one-offs relate to, say, policy changes in policy, the cost of rates and water, and they're backward-looking. They're not necessarily reflecting underlying wages or cost pressures in the economy. It's policy-driven. So last month, the Reserve Bank Board did acknowledge that there were one-offs, and this month they're saying that basically they need more time to work out whether those inflationary pressures are persistent going forward or not.
Yeah, it's a pretty short statement. I've just had a quick glance at it myself. It doesn't go into a huge amount of detail when you compare it to the November statement. I mean, it really does point to the idea that the RBA is still data dependent.
That's right, and that's the other thing we're essentially looking for is whether they maintain maximum optionality, so not ruling out anything like a cut, a hold or a hike, and that seems to have been retained. I guess one of the reasons why the statement was a bit on the shorter side this month is we know in February we'll get a full update of the Reserve Bank's own forecast in the Statement of Monetary Policy, and they'll be able to provide, I guess, more details in that policy statement to reflect those updated forecasts. I expect them to have more of a steer on whether they think these higher than expected inflation reads in the quarter that's just gone and in the monthly is more of a persistent feature that they expect going forward, or relates to a bunch of one-offs. So that's to come, and that's why we think it's basically a shorter statement this month.
In the GDP data that we received just a little while ago, we saw private demand, that is business and consumer spending, doing quite a bit of the heavy lifting. The RBA has pointed to a recovery there. I mean, the fact that we're not getting rate cuts and the economy is growing relatively well, that's a good thing, isn't it?
Absolutely, and that's what we needed after a period of softness, the private sector to bounce back, and we're seeing that in the data. And we also needed that because we've seen growth in public demand or public government spending slow down over the last few quarters as well. So something needed to pick up the slack, and we're seeing that on the private side. The question becomes is it too much of a good thing? Are we seeing too much of a bounce back in private demand or spending? And that remains to be seen. I guess what the Reserve Bank will be looking at is the labour market. So we get another read of labour market conditions on Thursday, and inflationary pressures. And if the inflationary pressures continue to point to upside risk, well, maybe the economy's a bit too hot. But if it doesn't, and we see a bit of a normalisation as these one-offs kind of dissipate and flow through the inflation numbers, then there may be a bit more capacity in the economy to absorb that demand. So it remains to be seen. In terms of Westpac's view, our view is that a lot of that September stronger than expected inflation read was driven by one-offs. And we expect the labour market to continue to gradually ease. And we saw just last week, the labour accounts showed that employment grew by 1.2%. So that's below the rate of growth in the population. And that's the slowest employment growth since 2017. So we think there'll be a gradual easing in the labour market, wage pressures will come down, and you'll see disinflation next year. And that's kind of our view. The market's obviously taken another view. They're of the view that the economy's way too hot at the moment, and you may need policy to be calibrated to get inflation back to target. But I guess the Reserve Bank's in the fortunate position where it can wait and see where the data lands, and I guess which state of the world that data is consistent with, and that's why they've left maximum optionality in the table and haven't really provided any forward guidance in the statement.
As you say, Westpac, along with AMP and Beta shares, and perhaps a few other economists think a rate cut, or in your case, 2 rate cuts are possible next year. Is there anything in this statement that does change that view, or do you think it would need to be reconsidered, or does this pretty much keep you where you are?
I think this keeps us where we are. I think once we see more of the inflation prints over the next few months, and at the end of January for Q4 2025, I guess we'll reassess whether our view of this gradual easing in the labour market, a recovery in productivity, and therefore a gradual reduction in unit labour costs, persists going forward or not. But we're really waiting to see kind of those inflation reads. And we think the fact that the Reserve Bank is still making its mind up on whether this stronger than expected inflation will be persistent going forward suggests that they're on, in a similar boat, just waiting to see whether it's actual, the economy is running too hot, or basically what we saw over the last month when it comes to the inflation read was basically, a bit of a mix of one-offs as well as, price hikes elsewhere. So that remains to be seen. So we'll probably, remain on the same call until we see, anything that contradicts what we're expecting.
And of course, we will get the comments from Michelle Bullock in around an hour's time, the RBA governor, which may give us a little bit more clarity about the RBA's thinking. Pat Bustamante, thank you so much for your time.
Thanks a lot. Thank you.
And Ros, so you can hear there that the RBA essentially acknowledging the inflationary picture and the pickup in business and consumer spending, but still leaving all options on the table when it comes to a cut, a hold or a hike as we look forward into 2026.
We'll get more on the rate coverage in just a moment, so please stay there, Alicia. But first, we're going to get an emergency warning to you for a fire in New South Wales in the Capity National Park near Bogey. This fire is burning in the area of Home Hills Road. It's burning in an easterly direction under westerly winds. People in that area are being told to leave now. The fire may impact on properties between Marsden Road and Capity River on Home Hills Road area, and embers may be blown ahead of the main fire front. If you are in the area of Home Hills Road between Capity River and Marsden Road, you are in danger. Leave now in a northerly direction along Home Hills Road if the path is clear towards Rylstone. We'll bring you more during the afternoon, but just reinforcing that message, do not delay. Act now. Conditions may get worse quickly. You can keep up to date with the latest warnings by listening to ABC Local Radio or going to the rfs.newsouthwales.gov.au website. We'll bring you more during the afternoon, as we said. Now let's get back to rates. The Reserve Bank has left rates on hold as expected. Let's go back to David Taylor, who's at the Reserve Bank there. David, you've had a chance to read the statement accompanying the decision. It's a pretty short one, as we've heard, but what stood out for you?
Oh, look, it's a short one, but it is full of the important information that we need. And the picture can be a little muddy if you don't follow it regularly like we do. So I'll just break it down into really simple points, which is number one, the Reserve Bank even though it's a little bit uncertain about what that October monthly inflation figure, what it points to, and they want to see more sort of information on the inflation front, the Reserve Bank has said in the statement that it fears that the inflation outlook more broadly is starting to hot up again. That's the most simple way I can put that. So the inflation heat in the economy is starting to spread a little bit. But in addition to that, and this is really important, it views the labour market as still pretty tight. Now, there is some reasons, there's some arguments that suggest the labour market might loosen a little bit, which is another way of saying the unemployment rate might move up a little bit. But for the moment, the Reserve Bank thinks the labour market is still pretty tight. Now, both those things combined would suggest that the Reserve Bank is very hesitant about cutting interest rates. And it's the line then that comes up in the final two paragraphs of the Reserve Bank statement, which says, the Reserve Bank now thinks that the risks to inflation are, quote, tilted to the upside. So that's a really key change from the Reserve Bank today. We're no longer looking at it being more likely that interest rates are going to come down. The Reserve Bank today is saying it is more likely, even if that chance is ever so small, it is more likely that the next move in interest rates is going to be up. And that is simply because the Reserve Bank is not sure that it has inflation under control, Ros.
Let's go to Alicia then for the final word, and let's look at the markets. Much reaction?
Not really. It wasn't a surprise to anyone that the interest rate level has been kept at 3.6%. So we were seeing the Australian dollar at 66.2 US cents. It's fallen very slightly. Perhaps there wasn't as hawkish language in the statement as traders might have been expecting, but in any case, it's pretty much where it was, albeit down 0.03%. And as for the ASX 200 index, it has fallen by about, like 4 points. So a very muted reaction from the market, but that's not surprising because it was no surprise.
We're breaking in to take you to the Federal Treasurer, Jim Chalmers, speaking after rates were left on hold this afternoon.
Who are doing it tough, even after rates were left on hold today. So this was the expected result. A lot of Australians would have wanted some more rate relief, but they wouldn't have expected it. There was, in the estimations of the markets and the economists, no chance of a rate cut today, and that's what we've seen in this decision taken independently by the Reserve Bank. Now, a couple of points about the statement that the Reserve Bank released. First of all, they point out that the inflation number, which has come out most recently, which is much lower than this government inherited, but higher than we would like, is a mix of some temporary factors and potentially some ongoing factors. And so they point to in the statement, they point to the fact that some of this inflation that we've been seeing in recent months comes from temporary factors. In the usual cautious and considered way, they will monitor the developments in inflation, including seeing some of those temporary factors wash out. But the second emphasis in the Reserve Bank statement today is really about the recovery in the private economy. The story of our economy in 2025 has been the very welcome, very encouraging recovery in the private sector, and the Reserve Bank has referred to that once again. From time to time, you'll hear some absolute rubbish from our political opponents who say that the bank is focused on public spending. The Reserve Bank hasn't actually said that public spending's been a factor in their decisions throughout this whole year. No mention whatsoever of public spending in today's statement. In fact, the opposite. They point to the fact that the heavy lifting in our economy is now being done by the private sector. That's a good thing. That's been the story of 2025. In fact, if you go through all of the statements that the Reserve Bank has released throughout the course of 2025, the common theme and the encouraging theme is the way that private demand and the private sector has overtaken public demand and the public sector as the primary driver of growth. We saw in the most recent national accounts that business investment is growing very strongly, housing investment recovering as well. We've had 4 consecutive quarters of productivity growth. All of those things are good developments. The Reserve Bank has not mentioned at all public spending or public demand in the statement that they released today, and throughout the year it has not been a factor because it's been the private sector taking over, and that is a good thing. We want to see this inflation moderate more, but it is only a bit over half what we inherited when we came to office. So Australians have made a lot of progress together on inflation, on real wages, on this recovery in the private sector. We know there's more work to do, and there are elements of the Reserve Bank statement which make that clear as well. Happy to take a couple of questions.
Do you think, with that recovering sector that you spoke about, do you think that rising interest rates will be sort of an inevitable consequence of that recovery?
Not necessarily, but I don't make predictions or preempt decisions taken independently by the Reserve Bank. There are good reasons why treasurers of both political persuasions don't do that. The bank has its job to do independently, and I'm focused on my job. And my job is to work closely with Katie Gallagher, the PM and the Cabinet, to deliver a very responsible mid-year budget update next week. And that's my focus. You know, the defining feature of this Albanese Labor government's been responsible economic management. That will be the defining feature of the mid-year budget update as well. And as the Reserve Bank Governor has said on other occasions, what sets us apart a bit from other countries around the world is we've delivered 2 surplus budgets. We've got the third-year deficit down to a fraction of what we inherited. The Liberal debt is down a couple of $100 billion because of our efforts. We've found $100 billion in savings. And so that's our job, to manage the budget and the economy in the most responsible way that we can, and we're doing that. And we leave the Independent Reserve Bank to focus on doing its job.
With my FA coming up, do you think the government will need to find spending cuts to ease pressure on inflation?
There'll be more savings in the mid-year economic and fiscal outlook that we release next week. There have been savings in each of the budgets and budget updates that we've released, and that's because we recognise that budget repair and responsible economic management is an ongoing task. The job is never finished when it comes to making sure the budget is as responsible as it can be. And as I said, we've already found $100 billion in savings. We've redirected that to more important areas like strengthening Medicare, building urgent care clinics, cutting income taxes 3 times. Making sure that...
Hello and welcome to viewers on ABC TV. We're hearing from the Federal Treasurer Jim Chalmers, who's speaking about the Reserve Bank's decision to keep rates on hold.
Budget update next week. Some familiar elements: savings, spending restraint, banking upward revisions to revenue, making sure that we get the budget in as good a nick as we can at the same time as we fund our priorities, including helping people with the cost of living in an ongoing way.
Australia's world-leading social media laws come into effect tomorrow. How important a moment is this for us as a country?
Well, this will be a game changer for Australian kids and for Australian parents. This is all about making sure that the young people of Australia are safe online, making sure that as technological change accelerates, that we can be beneficiaries of that change, not victims of that change. And I think you don't need to be a parent, but it helps to understand that our kids are not as safe online as we need them to be. And that's what motivates these changes. And here I pay tribute to Minister Wells and the Prime Minister and my Cabinet colleagues for working through these issues in a considered and methodical way over a period of time. We know that there'll be bumps along the road. We know that people will find their ways around different elements of these new arrangements, but overwhelmingly, this will be a game changer for the kids of Australia, the parents of Australia, our country more broadly, and that's why the rest of the world is paying close attention.
We expect energy costs to be a big part of inflationary pressures. When are we going to hear about the government's gas strategy going forward?
Well, we've been in discussions with the relevant ministers about the gas strategy. People would be aware that we're putting the finishing touches on that. I'll leave the timing of any announcements to Ministers King and Bowen and the Prime Minister to determine. But it's all about making sure that as we transition to cleaner and cheaper energy, there will be an ongoing and important role for gas, and we need to make sure that there's enough supply at affordable prices. And that's what motivates our work when it comes to the gas strategy. And again, you know, Minister King, Minister Bowen, the Cabinet, Minister Ayres have been heavily engaged on this for some time. There has been a review done. There's been a lot of work done with the sector to make sure that we get this right, and when we're ready to announce it, we'll announce it.
Just back to the social media laws, is it frustrating for the government that this occasion has been somewhat overshadowed by Annika Wells' expenses?
I think it's a really important change that comes into force tomorrow, and that's what we're focused on. And inevitably, The news cycle will be focused on all sorts of different things, but for us the focus is on the mid-year budget update. It's on landing these game-changing, world-leading social media reforms and making sure that this continues to be a year of delivery. 2025 for this Albanese Labor government's a year of delivery. We have been working our way through the commitments we took to the people in May when they placed their trust in us, and we've been implementing the policies that we took to that election. Strengthening Medicare, strengthening protections for kids online, delivering responsible budgets, making medicines cheaper, cutting student debt. These are all of the things that we took to the people in May, and we've spent 2025 delivering on those commitments. Great, thanks very much everyone, appreciate it.
That's Federal Treasurer Jim Chalmers there speaking after the Reserve Bank left interest rates on hold today, as expected. We are expecting to hear from Shadow Treasurer Ted O'Brien this afternoon as well. And also the Reserve Bank Governor Michelle Bullock will outline the reasons for the bank's decision. That's in about half an hour's time. We'll bring that media conference to you live when it gets underway. In the meantime, let's go to our finance reporter, Alicia Barry, who's with me in the studio. So, Alicia, no rate relief before Christmas, but any clues as to what the RBA might do next year?
Well, there was no surprise in the decision today. The RBA kept the cash rate on hold at 3.6%, where it's been since August. Now, the RBA has cut the cash rate 3 times this year from the height of 4.35% at the beginning of the year, now taking the cash rate down to 3.6%, where it has sat for the last few months. What was really of, interest to economists, markets and to those who would really like some rate relief is the statement that accompanies the RBA's decision. Now, the RBA pointed to the fact that inflation has been higher. We saw both the September quarter number and the monthly October number come in hotter than expected, both on the headline and underlying rate. And that has sort of changed the picture, I suppose, for forecasts for rate moves, with many now predicting that in 2026 we will see a hike. The RBA itself has pointed to the risks that inflation now poses being on the upside. So there is more of a risk that inflation will increase, but it is also mindful that this is going to take some time to assess. The monthly data series that we got that showed inflation at the headline rate is 3.8% is a new series from the ABS. The RBA wants to keep inflation between 2 and 3%. It's also pointed to a private demand recovering, and we saw this in the most recent GDP numbers, and in fact Jim Chalmers, the Treasurer, just mentioned it. That is a good thing, but also potentially inflationary and labour market conditions, according to the RBA, still look a little bit tight. So on that basis, the RBA is cautious, it says, but it is going to update its view of the outlook as the data evolves. So again, it's pointing to this idea that it is going to be data dependent, but really alive to inflationary risks in the economy. Some analysts are reading this statement to mean that rate cuts are basically done and that the risk now is for a rate hike. It is probably worth noting that this is not as hawkish as some in the market were expecting. It's probably a more calm, measured statement. It says that it is going to pay close developments in the global economy, financial markets, trends in domestic demand, outlook for inflation and the labour market. And it's going to essentially be watching everything in order to do what is necessary to achieve its mandate to deliver price stability, that is inflation between 2 and 3%, and full employment. So look, it is a bit of a walk the line statement, if you like, with probably a tilt to the risk being interest rate hikes, but certainly not as hawkish as some were expecting in the market. And we will obviously get more clarity around what this statement means when Michelle Bullock is questioned at her press conference in just under half an hour's time.
We'll go there live when it begins. And market reaction?
Well, because it wasn't a surprise, and because this statement really kept the door open to keep interest rates on hold, to potentially increase rates, and even if things deteriorate quite quickly, it has left the door open to cut as well. It's a very data dependent statement. The markets didn't move all that much. So we were looking at the Australian dollar sitting at 66.2 US cents. It's picked up very slightly now and is sitting at 66.4 0.27 US cents. As for the ASX 200 index, it was off about 0.2%. It's now off a third. So you can see a fairly muted reaction so far from the markets, but that could change as we hear from the Governor.
OK, Alicia, thank you. And the Shadow Treasurer, Ted O'Brien, is reacting to today's interest rates decision in Brisbane. We can bring that to you now.
Today's decision by the RBA confirms that this government cannot manage the economy. It's tragic news for households just ahead of Christmas to think that there will be no relief and the year ahead will be even worse. The government promised Australians the opposite of what they are delivering. Everybody is being held back. Everybody is being left behind. The opposite of what Labor has promised. The Reserve Bank is not to be blamed for today's decision because it is a direct consequence of Jim Chalmers' management of the Australian economy. He has failed to stop his spending spree and he has failed to start growing the economic pie. The average Australian mortgage holder is paying $1,800 more in interest every single month compared to when the Coalition was in government. That won't change. In fact, next year, it's likely to get worse. I think it's young Australians in particular who have been hit by Labor's management of the economy. And you see that through today's decision by the Reserve Bank. There are so many young Australians who cannot afford to buy a home. And every time they try to look at that online mortgage calculator, the numbers just do not add up. Today's decision will continue to see it very difficult to add up. In fact, next year it will be even more expensive for young Australians who want to enter the property market. Then you think of the young Australians who have recently entered the property market on the promise by this government that interest rates would come down. That's not the case. That's not the case because they continue to pay that additional $1,800 extra every single month. You also see that real wages have declined under this government. In other words, Australians are getting poorer. Real wages have dropped by over 2%. Now, when you think about it, prices have been soaring, real wages have been dropping. This is what has squeezed the everyday Australian household. It's why young Australians with families in particular are going to Christmas and they don't know if they can afford those additional presents for the kids. Some are cancelling their holidays. They're weighing up what they're going to do next year because according to all the forecasts, by this time next year, they'll be poorer than they are today. Again, this is a direct consequence of the Labor government's poor economic management. It's not the job of the RBA to try and set the speed limit for the economy. That is the job of the Treasurer. And Jim Chalmers has now put a cap on Australia's speed limit. And this is a problem. Now, the RBA Governor has effectively said just this. Because of the poor productivity in this country, over 100 days since the Treasurer's economic roundtable, productivity continues to be a problem. There's been no substantive measures from that roundtable that is going to improve our productivity. But unless productivity improves, well, economic growth will only start triggering higher inflation. And this puts the economy in a bind. It is why we are stagnating as an economy. And who loses from this? Everyday Australians. Everyday Australians are feeling poorer today because they are. And today's decision indicates yet again that they are dealing with a government which promises one thing and delivers another. Any questions? Are we okay? Please.
Economists say that the RBA is concerned about a broad pickup to inflation in their statement they released today could mean more rate hikes even into next year. Is that a concern?
It is deeply concerning to think that the next move in rates will be up, not down. This will only make it harder for everyday Australian households.
Now, there's also, the board have said that they think it's appropriate that they remain cautious with keeping the cash rate on hold. Do you agree with this, or do you think that there needs to be more looking into how to sort of curb and manage inflation?
Oh, look, I'll never double guess the independence of the Reserve Bank. I understand the problem they face. I wouldn't be surprised if the Governor herself would love to have thought that interest rates could come down to help everyday Australians. But because of the state of the Australian economy, thanks to the Labor Party, that cannot happen. If anything, what the Reserve Bank needs is the government to stop its spending spree. Because the more money the government pours into the economy, the more it competes with households and with businesses. And when they do compete, prices of everything go up, inflation goes up, which is why you see headline inflation now at 3.8%, way above the 2.5% target. Again, the government has to stop that spending spree, because if it doesn't, the Reserve Bank cannot reduce interest rates. It's the government which is hurting the Australian people at Christmas time, when people should be happy, not hurting.
Well, given that the Treasurer yesterday announced that he was cutting those energy rebates, isn't that something that would effectively help curb inflation?
Well, there's no doubt that now that the government will be curbing the rebates for energy, the Australian people are just about to feel the full brunt of Labor's failed energy policy. Labor has spent $6.8 billion papering over their failed energy policy. Now they're about to feel the full brunt of Labor's policy. Energy prices have gone up by around 40%. It's the Australian people who are going to pay. Labor has spent now 3.5 years not dealing with the source of the problem, which is a failed energy policy, but papering over it by dealing with the symptom and looking at rebates only. You know, the Coalition has always supported families when they need relief and assistance. The issue with Labor is every time they have sought to provide assistance, they haven't found room in their budget elsewhere. They just keep spending money. It's come to the point now they've run out of money. Taxes are way too high and debt's about to hit $1 trillion. This is the $1 trillion treasurer, otherwise known as Jimflation.
Do you agree, though, that that decision was the right decision to make to help sort of curb inflation?
I think it was inevitable that at some point those relief payments had to come off because they were camouflaging the real problem at hand. Whether Labor has the fortitude to now deal with the source of the problem, energy policy, we'll wait and see. But indeed, households are hurting, but they are hurting as a direct consequence of poor government policy.
Just a quick question on MyEFO, just around the corner. Does the government need to sort of find sharper spending cuts to relieve inflation pressures in the economy? What would the opposition sort of suggest?
There's no doubt that spending is out of control by this government, and the priority has to be to stop the spending spree and to start growing the economic pie. They should be the two imperatives that you see addressed in MyEFO. Whether the government does, let's wait and see. The government always says one thing and does another, and that's the problem. We'll wait to see what it does, but number one, what we should see is the Treasurer announce rules for his budget. This Treasurer is the first Treasurer since Peter Costello not to have quantifiable rules to contain his spending, which is why he just keeps on spending. This government just keeps on spending. There are no rules. Announcing such rules in MyEFO would be a great start. Secondly, they need to drive further efficiency in their spending. And thirdly, they need to get rid of government waste. They are the three immediate actions they could take if they want to stop the spending spree. And then there's another host of activities to start growing the economic pie and really addressing productivity. So real wages can go up rather than down. So living standards can rise instead of falling. These should be the priorities of the government as it goes towards MyEFO. Thanks very much for your time.
Ted O'Brien there, the Shadow Treasurer, speaking in Brisbane about the Reserve Bank's decision to keep rates on hold.